everyone, I'm Lisa.
Hi, I'm CL. Today we're going to talk about solutions to Mr. Paul's midlife crisis.
Hope this helps.
Hope this helps. Let's get started.
Wow, look at that. It's a sweet new man cave that we designed for Mr. Powell.
Yay!
So as we can see here, we can see the 4K projector, like inward surround sound speaker, karaoke machine as your wishes. Yes, you and your family would definitely enjoy spending the whole Friday night here.
So, how much does this project cost?
Well, to be honest, 75K.
Wow, that's not a small amount of money.
Yeah, I know, right? So we are here to help you to pick a suitable financial option for the payment.
In this research, we will be focusing on comparing different types of financial strategies that allow us to borrow the money and pay it back at a suitable interest rate. So we found 4 solutions here. The first one is loans. Personal loans. Personal loans gives you the credit you need with the fixed payment. It will take out a loan because you do not have the capital upfront. Loans has different rate, options, and payments schedule depend on the provider. As you can see here, we list out 3 different banks, which is BMO, RBC, and TD. They all have different variable rate and fixed rate. A fixed rate loan has the same interest rate for the entire of the borrowing period, while variable rate loans have an interest rate that changes over time. In general, variable rate loans have lower interest rate and can be used for affordable short-term financing fixed rate. We also calculate the average fixed rate for these 4 banks, and the rate is 12%. And we also calculate the monthly payment for you. You can see it here very clearly. And also the variable rate. I think the variable rate is a little bit lower than the fixed rate, and if you choose variable rate, a variable interest, and the amount of money you need to pay every month is a little bit lower, and there will not be so much stress on you for per month. Yep.
Okay, here we come to the second solution for Ms. Powell's midlife crisis.
Yes.
So we got the mortgage. What is mortgage? First, mortgage has the same concept as loans, which is we borrow the money from the bank or institutions, but different from loans, which are unsecured and has a higher interest rate. The mortgages are secured and tied to our property. This, in turn, means that we will get a lower interest rate. We can also pre-qualify for a mortgage to have a more solid understanding of what we will be paying every month. So here we compared the interest rate between 2 banks, BMO and RBC, and in the chart we get to some new vocabulary. The first one is the open mortgage. What is an open mortgage? It is a mortgage which can be prepaid at any time without requiring the payment of additional fee. And for closed mortgage, which is our second vocab, it is a mortgage agreement that cannot be prepaid, renegotiated, or refinanced before the maturity except according to its items.
Mhm.
So here we can see we picked all these data from TD official website. And here we can see the fixed mortgage annual percentage rate. On the right, we got different years of like terms of paying back money so that we got different rates for them. And on the right, we got the monthly payment according to the rate on the left. And we found the 5-year fixed close high ratio rate would be the cheapest till now. Yeah.
Mhm. Yep. So it's the cheapest data, the lowest data we've ever seen here.
Yeah,
Yeah.
till now.
Mhm.
So here we can see the TD variable mortgage APR. This annual percentage rate, as we can see here, isn't always that number like 3.262 and 1.57 because it's variable. In the mostly the case is that we don't know the percentage here. It's really up to the update from the bank, and sometimes we get a really low interest rate than the fixed rate, but sometimes we got a higher one. So how do we make choice between variable mortgage rate and fixed rate? It's normal to pay a higher rate for fixed compared to variable, actually. However, right now, as Robert McLeister, founder of RateSpy.com says, there is a little rate difference between fixed and variable. So, of course, the right choice of mortgage type depends critically on personal preferences and individual circumstances. But overall, you have to say to yourself that my chances of being right with the fix is probably greater than the risk of being wrong. So yeah, high rate always comes with high return. Checking rate forecast and adjust a financial plan would be the best solution for us.
Yes. And ignore the 15 here. It's 5 actually.
Yeah.
Yeah. Okay. So now we are come to solution 3. Solution 3 is for member card, and a member card.
Mhm.
A member card is a small card issued to and held by a member of a club, society, or other organizations, verifying the member's membership for a given period. So I think the best example here is Best Buy. Best Buy has an administrative fee for the installment payment, and it is $50 in a year and $100 in 2 years. The interest rate is always not changed. It's always 4.9%. And then we can use the formula to calculate the monthly payment. And we found out it's pretty high if you would like to pay it back in 1 year. And yeah, and
In the long term, we got 5 years, which is 1,600 more, which is quite less than 1 year's one,
yeah,
because we have a longer term.
time to pay it back.
Yeah.
But if you want short term, I actually don't suggest this one because it's too much stress for per month.
Mhm.
Right. Yep.
So our last solution, credit card.
Mhm.
As we all
Yeah.
know, credit card is like we can borrow money from bank at any time we want, but in return for that, we got to pay a higher rate, interest rate than the loan and mortgages. Yeah.
Mm.
So Here we can see 3 different credit cards. These 3 are actually all low interest rate credit cards. When we are choosing the credit cards, we actually pick the low interest rate credit card because it might help more when we're doing the 75K purchase, which is a really big amount of purchase. And yeah, so here's the winner, TD. It got the lowest interest rate, which is 11.99% every month. Yeah. So according to our old friend, compound interest rate formula,
Yes.
we calculated the monthly payment for TD MasterCard, which is $2,269.75
Per month. Yeah.
Yeah, that's our last solution.
Yeah.
Now coming to the conclusion.
Conclusion. So we list our 4 solutions here all together, and we make it all 5 years paying back. Then you can see the data here very clearly, and you can do the comparing more easier. So for long-term solutions, we suggest mortgage because it has the lowest interest per month. Then you can like pay a little bit every month for a long term. Yeah, but for short term,
For short term, well, we might suggest a personal loans or a member card. But with short term, of course, we might need to pay a higher interest rate. Yeah, and for the last one, credit card. This one we don't really recommend because our purchase is really large, which is 75K again. We have to pay a lot of interest every month compared to the previous 3 if we use a credit card.
Yep.
Yeah.
Yes. Yes. So that's all of our solutions, and hope this helped you.
Thank you.
Thank you. Bye.
Bye.